Hello, everyone, and welcome to the MakerDAO Scientific Governance and Risk Meeting, number 133, taking place on Thursday, March 18th, at 1700 UTC. My name is Long for Wisdom. I'm the Governance Facilitator at MakerDAO. I run these meetings. I'm joined, as usual, by a bunch of awesome Maker people. Who are all probably sick of me saying this by now. Yeah, and we've got our kind of usual selection of weekly updates from the various groups within Maker. We've also got a couple of segments to go to kind of discuss. Smart contracts have a segment on Liquidation 2.0. And then we're also, if we have time, well, we should have some time, we're going to get into a kind of brief discussion maybe over the core unit MKR vesting, kind of continuing the conversation from the meeting yesterday. Don't worry, we'll kind of summarize the kind of points raised in that meeting for those that weren't there. So before I guess I dive into my segment, quick reminder about daylight savings. I think for some portion of people this has already happened, but for some I think it's still coming in the next few weeks. So be aware that this meeting is kind of defined in terms of UTC. So if you're in a country with daylight savings, it'll shift by an hour one way or the other, or the same way, I expect. All right. So usual kind of preamble. If you have something to say or comments or questions, please interrupt. We kind of like hearing from the community. Someone will I'll kind of let people know if we need to move on for reasons of time or anything. So please do get involved. All right, I'll start with the weekly updates on governance then, kind of briefly going over the executives and polls we've had in the last week. So last week's executive, we passed, which brings us the ETH vault type, which is a new vault type using ETH as collateral, with a lower stability fee and a higher liquidation ratio. So for those people who are a little bit, I guess, less or more risk averse, I suppose. It also brings some small stability fee adjustments to some of the Uniswap v2 LPs, and I think some other minor ones as well. The full list is obviously on the portal as usual. So we should see that execute soon. I believe it's either today or tomorrow, maybe tomorrow. So this week's polls have also now finished. We had the Optimism DAI bridge poll, which is a little short notice, which passed, which is great, confirming that the community and Maker token holders kind of want the smart contracts team to kind of pursue creating the Optimism DAI bridge as described on the forum. We had the monthly MIPs governance poll pass, which is good to see because there's a lot of juicy kind of MIPs in there. We saw the poll to increase the dust parameter for most poll types to pass. We also were supposed to have another dust parameter poll specifically for ETHB. In the end, this didn't actually go up on the portal because of an error in the poll that we kind of missed until Wednesday. So we decided to skip it till next week. So it'll go up next week. I don't imagine that will cause anyone any grief because ETHB is currently maxed out anyway. But yeah, we kind of looked into it. We just kind of missed something from our usual checklist that we shouldn't have. So hopefully it won't happen again. Let's see, there was also a poll to increase the ETH-A and Wbtca maximum debt ceilings. ETH-A, the poll passed to move the debt ceiling from 2.5 billion to 15 billion. So big increase there. And then for Wbtca, from the current 350 million to 750 million. So again, pretty large increase. I think this kind of reflects the fact that people are kind of sick of micromanaging this. Now we have the debt ceiling instant access module. And I think the kind of rough consensus is to use the stability fee to manage usage in the future rather than strict limits. So we also have green light polls still active for 9 potential collateral assets. So if you haven't voted in those, please consider doing so. Those are going on for another, I think it's on Monday, possibly another week. I forget. So yeah. The executive this Friday will include the ETH-A and Wbtca maximum debt ceiling increases and the dust parameter change for most vault types. think that goes from 2,000 to 5,000. And then so we also have an executive on Monday as well, which will be the monthly MIPS executive, which will include the final ratification of the MIPS in like March's monthly governance cycle. In terms of the governance domain itself, we're kind of working on a couple of things. The kind of source code payouts will be so the funding for source code payouts is kind of transitioning to be paid by GovAlpha, which is the kind of first governance core units. So we're kind of dealing with that with source code and sort of organizing that transition. A couple of us have been working on MIP0 changes to kind of make it more streamlined, easy to understand, more accessible. Pres and I have been working on Liquidations 2.0 parameter documentation. Eli's been kind of working on the vision setting working group. And yeah, MIPS portal work is kind of continuing. Not quite ready for show off anything new yet, but work continues. So let's see, I think that covers my parts of the governance updates, but maybe is it this week? I think Pros can give us governance at a glance.
Yeah, posted a link there so you can follow along if you like. Another pretty exciting week here. We're at an all-time high again with the DAI in circulation, looking at 2.85 billion. Very exciting there. And in case you missed it, we also passed the 100 million DAI mark in annualized stability fee revenue, which is pretty exciting. And DAI Decipher, I don't know how many people use that to kind of look at the state of the peg, but it's back to kind of full functionality, and we're even getting more decimal places on our weekly VWAP. So we're actually down to $1.002. Again, super exciting. As far as announcements go, we do have an art contest that's closing up. I believe there's about 2 more weeks left for submissions. And we're paying out up to 8 places with DAI prizes. So if you have friends that create visual arts or you want to get them involved with Maker, that might be a neat way to do it. Got a few discussions going on in the forum. One that's still posted from last week was on the NFT vaults. Aaron brought us that after Beeple's NFT sale for 69 million closed at Christie's. So pretty exciting discussion there in terms of what we need to do to try and implement NFT vaults. Juan brought us a blind spots check post, which is getting a lot of really good discussion, talking about any assets that might be getting forgotten about or that we need to make sure have a core unit transition as the foundation steps aside. And then finally, Mio did have a petition letter to not necessarily just A16Z, but kind of talking about formatting letters that we could be drafting to VC holders to get more active governance participation from them. We're back to having a bunch of signals this week, so do be sure to hit the forums and vote. A couple of them I wanted to highlight independently, and that's first one asking for DC raising and implementation of the debt ceiling and access module for the Uni V2 pairs. Not quite all of them, but a good chunk of them. I know the community's been waiting for those for a while, so pretty exciting to get the chance to finally vote on the signal there. And then another one I wanted to highlight is a signal request asking to raise the surplus buffer from Shupi there. And this one in the thread of the post has a really good risk assessment that Seb typed up for us, talking about like perhaps what a safe stability buffer looks like given Maker's current portfolio. And just so I list them so you remember to go vote, there are signal requests for the debt ceiling lines on 0x, Compound, Wi-Fi, and then as well as a DC raise on the PSM for signal request outstanding. So that about does it for me. Be sure to hit the forums and share those votes.
Perfect. Thank you very much, Pros. Yeah, and as Pros said, lots of signal requests on, so please do vote if you haven't already. All right, I think that brings us to our smart contracts updates. Chris, I know you have some kind of more liquidations 2.0 stuff, but we can maybe have that later, just in case you.
Yeah, I let's see. I can get to. I can sort of rearrange that to put it at the end, and then we'll swing back to it after everyone's updates.
Perfect.
So before I do the liquidations 2.0 stuff, I'll just cover and say we're still expecting to do the dress rehearsal with Matt. We've just been, super busy. Haven't gotten a chance to sit down and do that for success. And then, oh, you guys still there? Okay, actually, yeah. Oh, Pro, stay animated. That way I know if you guys are going to freeze on me. For MIP 22, we sat down with Centrifuge yesterday and found a pretty good path to, shoehorn this into sort of MIP 21 format, and that the sort of changes that we needed to make were pretty low touch. And so we're going to review a little bit more of that, I think, tomorrow. And so I think there's a chance that we'll see MIP 22 actually kind of just become a MIP 21 collateral type, but their entire kit may be going to Covan as early as next week. So that's pretty exciting. And that's almost perfect because it'll fit in this like little window that we have right now. So there's still some like security team review work happening. And I guess more on that once our team gets to review it, and then we'll like release some documents on the sort of roadmap there. And yesterday we had the SC core unit discussion. And then so for the big one, which is where we've been spending all of our time, which is why we don't have new collateral additions or anything else right now, is that MIP 45, which is liquidations 2.0, has been heavily under development. We finally deployed liquidations 2.0, our release candidate 1, into Covan. So this is its own sort of bespoke deployment of multi-collateral DAI in Covan. It's not our normal like Covan staging environment. So I dropped the all of the addresses for that deployment in the collateral onboarding updates X channel. So if you guys aren't in there, like feel free to go in there and check it out. Also the config file, which is worth paying attention to because we tried to make it easy to like sort of iterate quickly and test in there. And we changed a few things like the tail and the cusp between collateral types, so you could see different expirations. So if there's like keepers that are going to test that out, they can try different things. So any integrations, any integration partners, any UIs, feel free to start like using that to at least start to like, test your code. And then we're going to move into working on the spell for Covan to make it part of our actual staging environment shortly, probably maybe Friday or next week. We worked on some ilk registry changes for liquidations 2.0 as well. The auditors, so QuantStamp is finished with their final report. PwC is finished with their final report. The Trail of Bits is still ongoing, and Gauntlet is still ongoing, which actually kind of brings up so there are a number of things that came out of that for clarifications to the MIP. And there's also the addition of those audit reports. Now that they're finished, we want to add that to MIP 45. And so at some point, Long will work out with you exactly how we do that, because it's informal submission, so we don't want to make the change yet, but maybe in a comment we can link to the pull request that shows the sort of like changes. There's nothing substantial changing, just typos and invariants and stuff that are being updated. So yeah, so let me actually here. Can you give me screen share capability? Do I have that?
Sure, one sec.
Yeah.
Okay, you should be good to go.
Oh, cool. I can let IME in. All right. Screen share. Okay. All right. Can you guys see the timeline right now?
Looks good.
So this was yesterday. So this is today. So the Covan deployment went out this morning. That's sort of release candidate 1 deployment. And You can kind of see where we're expecting to get some things in here. So the audits, Trail of Bits should maybe finish tomorrow. And Gauntlet, we may have a final report coming. I mean, it's more iterative with them, so we'll see exactly where that process stops. But they're working heavily with Risk right now. We'll put a bug bounty program up around the same time we do the mainnet deploy. What I wanted to bring up here is that we're working on an issue this week, and that issue kind of pushed back a little bit of like the Kovan deployment. We're actually kind of hoping for Monday. And so if there's any integrators in here that end up crunched for time or need a little bit more time, please be very vocal and let us know, and we can kind of grab this.
Starlink got down.
Wait for it.
Starlink went down.
I don't know if anyone has any questions about the schedule. It's up right now. Feel free to ask. Oh, shoot. Am I back?
You're back, yeah.
Okay, cool. Yeah, sorry, everybody. Space. Yeah, so if there's any questions about this, feel free to ask. And right now, and I'll talk about anything in this timeline. And all right, I'm going to stop sharing if there's no questions.
Yep.
And let's see. So let me just finish up the last bit, which is I wanted to kind of, so we've been dealing with a liquidations 2.0 issue, which I think we're going to talk about in a little bit later. That way everybody gets a good idea of what that issue is and the sort of risks with it and whatnot. So, but as you can see, it hasn't affected the timeline. So, but I think we want everyone to be, aware of it. So we'll come back to that. That's it for smart contracts. If anyone has any questions, speak now.
Great, thank you, Chris. All right, so let's move on to oracles then. Nick, you here? Did I see Nick or did I not see Nick? No, I don't see Nick. Okay, maybe we'll come back to oracles. Pretty much risk update, perhaps?
Yep. Yeah, so we're currently writing a report on Link-A proposed parameters for Liquidations 2.0. So smart contracts, so Chris already mentioned that there's some specific risks that will be addressed later in regards to Liquidation 2.0. And we're also evaluating whether we can set some parameters more conservatively to mitigate these risks as much as possible. Gauntlet is also more or less finished the report, and I think they're planning to publish findings on the forum sometime soon. Our proposed parameters for Link-A should be based on the findings of our own analysis, but also the one made by Gauntlet. Here, I just want to know that Gauntlet specifically focused on simulations for it. So we might make few adjustments when proposing parameters for Link. Such as, for instance, have a bit less aggressive price curve function for Link because it has a higher liquidation ratio than it. Maybe some other stuff as well, but yeah, I don't want to go in depth now. So yes, next week we should hopefully have this report with parameters released. I hope we can also get enough feedback from other teams in due time. The other thing we're also working on now is a new framework for evaluating uni LPs risk premiums and their debt ceilings. So Nick proposed a higher debt ceilings for some uni LPs a few days ago. And we believe that apart from auction risks, those debt ceilings are reasonable, at least when looking at the liquidity of underlying tokens. It is harder to evaluate what are the risks associated with auctions right now for uni LPs, because we still haven't had a larger liquidation event to see, how many keepers truly bid in these auctions when more money is at stake. But it does make us a bit more comfortable after knowing that there were actually no zero bids for uni LPs and that certain UIs had a bug when they showed there were no bids, which means that despite low participation in these auctions, there was still some activity going on. The other reason that also makes us comfortable about raising debt ceilings on some of the uni LPs is the collateralization ratio distribution, which is very healthy for most of these LPs. So for DAI ETH, for instance, the median collateralization ratio is about 300. And the one which is debt weighted is even higher. I think it's around 900. So this is both very high, considering that the liquidation ratio is only 125. So this actually presents less risks, actually lower liquidation probability. So with that in mind, I think we can safely increase debt ceilings on uni LPs. At the same time, we also hope that if we had a larger liquidation event, we should see a decent amount of keepers bidding, also because we increased the minimum bid amount. So other than actively working on liquidations 2.0 and uni LPs, there's also some background work, mostly on optimization of some of our risk calculations. We're basically trying to convert all these risk files that are mostly in Google Sheets now to a more robust setting, so we can have those calculations run on AWS, and metrics would be shown publicly on some web dashboards. For instance, we're currently working on automizing slippage curves, which is kind of important when we're deciding about debt ceilings or auction throughput under Liquidations 2.0. And we started to use 1-inch API. So we actually will probably make a really good tool to measure on-chain liquidity, which is becoming more and more important. So yeah, everybody could see, how a particular asset that maker has in portfolio as collateral, how liquid it is, and it's going to be much easier to decide on some parameters. Yeah, and I think that's all I had for today. If there are any questions, please ask.
No questions from me, but that sounds cool with the on-chain liquidity check stuff. That sounds good. All right. If no other questions, then we can maybe move on to SIP with real world finance.
Thanks. Hi, everyone. So the good news is, as Chris told you already, that centrifuge assets will migrate to use MIP 21 and no longer MIP 22. Well, that will still be MIP 22, but not interacting with Maker directly. So that's a good news because it brings a lot of velocity to add some real world assets. So that's a super good news for the team, and I guess for centrifuge as well. We might have solved another issue we had on real world assets, which is USD DAI hedging cost. People in the real world obviously don't want to use DAI; they want to use US dollars, and so there is always a risk of price variation. So we both know that it will no longer be the case, but people still want to have some guarantee about that. And it seems that using the PSM brings us the stability with USDC, and with USDC you have the stability with USD. So by transitivity, we are quite pegged to the dollars. So still need some work to be done on this front to see if we should maybe do another PSM just for real world asset, or everything is open, just to see if it will work well in the future. But I think the USDC PSM will be increased as well, so it should be enough space for the next few months. Coming on 6S and all real world assets in general, I had a good chat with a lawyer that will be able to help us on the legal front, which is specialized in structured finance, which is a specialization inside the legal. So this is a good news because after the meeting, the lawyer was reading the Maker white paper, so that's not common, so that's good. And he found that he understood why everything is so complicated with us. So I'm not sure that was a compliment, but anyway. A bad news on analytics. So I told you last week that June will change some widgets they use, and there will no longer be any pivot table. So currently the financials for Maker no longer work because the front end is no longer working. So I will try to see what I can do and other analytics platform we can use to that. So it's kind of the same issue that Primoz is facing. We had a discussion earlier today on that. We are working a lot with data, so we need some data to work on. And the last part, the collaterals. So we have made some progress on FortunaFi. We had a good chat with them. And people companies, there is a new round of negotiation, but I hope everything will be fine. It could be a tough time to negotiate the good terms with them, but yeah, everything looks great. So if you have a question on any of that.
Hey, Sebastian, I got a question. Does the RWA team see any risk to DAI losing opportunities? And I ask because you're seeing like new platforms coming on, right? And new stable coins, which are looking to bring real world assets into the blockchain ecosystem. So I guess what I'm saying is like you have centrifuge waiting, right? And then there's like new protocols like Akala coming online pretty soon. And then yesterday's launch of Terra USD was pretty made a lot of headlines. And yes, I guess what I'm saying is, do we see a risk here where DAI is like since it takes like some time to get things going?
Yeah, so
do you see any risk of losing opportunities?
I don't think it's a risk for DAI directly, because, for instance, Centrifuge is doing business more and more. They are at 5 million now. It's increasing quite quickly those days, and they are still on DAI. But other competitors that are tokenizing real estate are no longer using DAI. We have a discussion with Goldfinch that are onboarding real world asset as well, and they use USDC. And that's not a good news for us, but I think it will only pay at the margin. Another thing that can be important, and maybe we should focus more time on that, is that we can use real world assets to gain market share for DAI. Let me explain. I know that, at least I heard that many companies in Asia are using USDT for daily transactions. They are not using DAI because, well, USDT was first. But you cannot get a loan in USDC. Maybe if we can find a way to give them loans in DAI, backed by invoices, backed by inventory, I don't know, maybe it will bring some visibility for DAI to those people that are really using stablecoin. Because obviously in the US, not much people are using DAI or USDC for daily transactions, mainly for farming, which is not the best use case. But in Asia, they are using it for doing cross-border business. So maybe by bringing loans to those businesses, we might increase the value proposition of DAI for them. But it's still another thought. And otherwise, I don't see USDC doing a business line on real world asset and stuff like that. But we clearly have competitors that want to bring a real world asset.
Okay, thanks
and
for the,
not using DAI.
Cool, man. We'll see. Thank you.
All right. Let's maybe move on to operational support. Who's doing the update this week?
I am. Can you hear me?
Yep.
Okay, nice. Hi, everyone. Yeah, quick summary from us. As we mentioned before, we're going to do a EuroDAI next month, so in April, with Ultra, Shupi, and Seb. So stay tuned. regarding collateral onboarding, as it was mentioned, we're working a lot on the ETH-C vault and real-world finance as well. For the calls, we will have a Bancor coming to a collateral call on Wednesday, April 7th, and then we'll have Solid Block for real-world finance on April 14th at 6 p.m. UTC and 5 p.m. UTC respectively. For the core unit updates, we have revamped a bit the Notion space we were using to present it, to try to make it more clear based on the feedback we got. So yeah, as always, go there if you have any questions, and let us know if there's anything we can improve. We had last week Long for Wisdom and his team coming for the session number 2 for the launching pod sessions. And then last Friday we had Sablier for the core unit tools. On Tuesday we had Cut Through Accountable with David. And yesterday we had the smart contracts core unit with Derek. All of them quite interesting, especially the one from yesterday, well, at least to me. So check it out, it's on YouTube if you want to. Tomorrow we'll have a Seb presenting real world finance core unit, which will be voted very, very soon. And next, well, this coming Wednesday, we'll have a Seth presenting the content production core unit. Then the news for the core units in RFC, we had the same 4, but David posted for RFC the governance communications one. So please give feedback if you have any. And then, yeah, I think that's it. There hasn't been any core units draft in progress, or not that we know of yet. And then for interesting topics of conversations, we have put the blind spot check, as Pros already mentioned. Yesterday I had a call with Seth. He started working on things that we should cover, so trying to map the whole space and see which core unit could take over different aspects. So I encouraged him to post it over there. And then, as we know, the maker vesting has been a heated topic these last days. So we are preparing a post. I'm not sure if it's online yet. I think Amy is going to post it. So that's pretty much from us. I'll leave the link here on the chat in case anyone wants to cover any of those points. And if there are no questions or comments, back to you, Long.
I guess one question which you could maybe kind of answer briefly. So we've seen like sort of a fair few core units, I guess, kind of go through the process at this point. I'm kind of curious how you kind of, or how operational support in general thinks it's going so far.
How the what is going for?
How like the core unit kind of structure is going, right? Like all the onboarding process and like the whole set of MIPs, right?
Yeah, I think it depends on what your metric is. I think it's quite exciting that we saw 3 core units take the first cycle already, and that's I think that's going well based on the reaction by the maker token holders and the voting, the feedback we've gotten. I think it's too early to judge in general, so we don't know yet. We don't know what we don't know, and it will be interesting to see how the community reacts to different core units being proposed, especially as we move them forward towards the voting area. That we still haven't got any core unit rejected, for example. So we don't know what the tolerance is for the token holders. So that will be something interesting.
Yeah, that's a good point. Yeah, but probably still a little bit too early to make judgments. But yeah, cool. Kind of good to hear your thoughts on it. All right. That maybe brings us to MIPS. Whose turn is the update this?
It is me today.
Awesome.
Yeah.
I should
Can you
remember.
give me-
There's only like 2 people, but like it's quite hard to remember when I get to the point.
Yeah, I don't mind. I don't mind if you ask either. It doesn't really matter. All right, cool. So here, let me share my presentation. All right, cool. Yeah, welcome everybody to the weekly MIPS update. My name is David Utrobin. interim MIP editor, working at the foundation as a community development lead. Many of you know me. And so, yeah, let's get started. So we are in week 3 of the March governance cycle. And so we're gonna, we're gonna see this entire MIPS bundle either, well, actually, we already saw the MIPS bundle get passed or fail right before this call. So that vote actually did pass. So we're here on the 18th, and on Monday, we're gonna see the bundled executive vote go out. So this week's updates, I'm just going to keep pretty short. All of the submissions for the March cycle passed the inclusion polls. This is a total of 10 MIPs and 11 subproposals. And so the bundled MIPs executive, goes out on March 22nd. I have slides for the included proposals, but we've shared these like pretty much every week. So I'm not going to spend too much time, reading them out or anything like that. So I will just slowly go through all of them here visually for you all. But yeah, it's 21 proposals, and they are all listed in the MIPS update. So yeah, participating in governance will make you happy. And so yeah, there's my presentation for today. Sweet and simple.
Yeah, great. Thanks, David. I sure hope governance makes people happy. It makes me happy.
And I posted
the
link to the fuller MIPS update if you want links and a list of the MIPS and RFC and the list of MIPS that are included in the executive vote on Monday.
Great, thank you. So yeah, for my part as the governance facilitator, I need to kind of confirm that the MIPS bundle will continue to the next week's executive proposal. I can confirm that it will. There was nothing terribly contentious in there. There's no reason for it to not go forward. So yeah, I expect to see that on Monday. All right. So I believe that brings us back around to smart contracts, maybe for our first kind of in-depth segment. Who's presenting this? Or talking about this? Is this Kurt or Chris? Or...
Yeah, I think we'll have Kurt.
Yeah, I will do this discussion. Right. So hi everyone. If you don't know me, I'm Kurt. I'm on the smart contracts team. And today I'd like to sort of convey information about kind of an additional risk, or not really an additional risk, but a more severe risk with Liquidations 2.0 that we've really come to appreciate in the last few days from some initial risk discussions. And specifically, it's a risk that's more severe in Liquidations 2.0 as opposed to 1.2. And then I want to say what we kind of recommend in terms of mitigating that risk. All right, so yeah, enough teasing you. What am I talking about here specifically? It's specifically the case of some sort of price reported by the oracles that is very low compared to the true market price. This could happen due to an oracle attack or a malfunction. You could have some sort of flash crash that has a quick recovery, but the oracles just managed to catch the bottom. Or it could, even in principle, be market manipulation of some sort. In Liquidations 1.2, you have an auction settlement price that's not related to the oracle price. That's because of how English auctions work. Further, the die target buffer, which you might know is the box parameter, combined with an enforced minimum time to settlement, limits the rate at which vaults are put on auction, which sort of minimizes your market slippage risk and ensures that you don't liquidate everything at once. So in an oracle price drop anomaly, Liquidations 1.2 is fairly robust and minimizes losses to the system, although there would be some, of course. In Liquidations 2.0, on the other hand, the liquidated collateral is offered for sale near to the oracle reported price at the start of the auction. And in the envisioned scenario, that starting price is well below market price, so the auction will quickly be bought out, locking into some sort of systemic loss. Further, the purchase clears the die target buffer in 2.0, which is the whole parameter, if you're following on the technical side. And that allows more liquidations to occur immediately. So the net effect of that is that in this same sort of oracle price fault scenario that's gone very low compared to the market price, basically all the vaults for an affected collateral will be liquidated in a short order. You're basically only limited by Ethereum block space, and there will be big losses to the system. Now, granted, we're not defenseless against this. We have a 1 hour delay applied to prices, and that gives MKR holders time to react using instant access modules to, say, freeze the oracles or disable liquidations. But the key here is that there's greatly increased severity if a bad price gets through compared to liquidations 1.2. And further, the incentive for a malicious actor to try to cause this to happen grows proportionally to the collateral in the system. And so that's not really sustainable and puts a lot of pressure on the Oracle security module as we scale up. So while this isn't a new problem, and we have the Oracle freeze functionality, and which we feel is sufficient for 1.2, the extra severity caused by that dependence on Oracle price for starting the auctions and the way they can be cleared much more quickly, we think calls for an additional measure to be put in place to contain the risk in 2.0. And so that's, before I get to describing what kind of additional mitigations we want to recommend, let me pause there and see if there are any questions about that sort of description of the concern.
So I don't have a direct question, but maybe I can just summarize my understanding of what you just said. So the issue is in 1.2, or the issue is less than 1.2 because our auctions start low and then go as high as the market price. Whereas in liquidations 2.0, we're in the situation where the auction starts at the Oracle price and then only goes downwards. Is that kind of correct?
Yeah, pretty close. I'd make a minor tweak to the wording and say that in 1.2, the auction price really isn't related to the Oracle price in any way. It's whatever participants are willing and able to bid for the collateral. Whereas then, like you said correctly, in 2.0, the auctions start selling, near to the market, the Oracle price. A little bit above it, there's a risk parameter that governs that. But you can imagine that if the drop is large enough compared to what the true price is, you might still start an auction below the market price.
Yeah, and also one distinction in liquidations 1.2, the box parameter acts as like a true independent sort of rate limit on the amount of DAI that we would request. So, and that's because the auctions have a particular TTL or tau that they need to clear. So a specific time window. And in liquidations 2.0, I mean, they're much more efficient. We don't have that time window, but you can imagine the extreme case, if we clear the whole, there's no independent like time-based rate limiter. So all of the collateral could go in this extremely like tail end risk could go very, very quickly out into auctions. So,
which, in some scenarios, that's actually a feature, right? If you have a real market decline and you want to sell your collateral quickly before the market goes down more, liquidations 2.0 is better in that scenario. But the sort of dilemma the system finds itself in is when some really low price comes in, the system doesn't know, like, did the market actually drop that much, or is this some sort of fault in the Oracle system? And when you look at how severe the risk is, the Oracle fault risk is just much more severe in 2.0, even though it's better at dealing with, hey, the market really did go down. So, it's when we were designing liquidations 2.0, we very much had Black Thursday in mind, which was a real market decline. So liquidations 2.0 is maybe a little over optimized to deal with that case. And so we want to think more about this Oracle risk now.
Yeah, sorry, I typed that in the side. Maybe I should say it. Imagine OSM price is the starting point plus the buffer is less than the market price. In any case where we're in that condition, those auctions can settle instantly. And in fact, you could liquidate more, take them, liquidate more, take them all in a single block and just empty it out at whatever price the auction starts at. So if you think of the extreme tail risk that we have an Oracle malfunction attack, whatever, if that OSM price is one way, we add some buffer onto it, which is usually 20% of the original price or 30 or something like that, so again, one way, then we let the entire set of collateral out for one way to auctions, all of it, just right out. So very low probability risk, extremely high impact if it happens.
You know, whereas with liquidations 1.2, just to highlight how it would be different, you'd have some initial wave of auctions that would get triggered, but they would hopefully, number one, they would settle near the market price, and they would take whatever the current lifetime of those auctions is to finish. So I think that's 4 hours for most auctions, and you know, only whatever the box parameter is. I don't know what that's, some number in the low millions or tens of millions, something like that. So that would be the amount of DAI, required by those auctions. It would mean that only some fraction of the collateral gets liquidated, and then hopefully after 4 hours or however long they take to finish, the Oracle price has been fixed or has recovered in some way, and so you'd only have that 15 million worth of DAI collected for some vaults that probably got wrongly liquidated, right? So there'd be some loss to those vault holders, but the system probably would be okay because the vaults should be able to settle near market price, not near Oracle price. And so that's a much less severe consequence than what happens in the liquidations 2.0 scenario. So let me go on and say what we're currently recommending as the smart contracts team. So, as I sort of alluded to a moment ago, the system currently faces significant risk from real market downturns and DAI liquidity crunches with 1.2. So there's no free lunch here, right? There's also aspects of risk that are better under 2.0 as opposed to 1.2. That's why we designed it the way it is. So we believe we can decrease this false price drop risk significantly in the short term with a special permissionless circuit breaker that we'll add. It'll allow anyone to disable liquidations anytime the next price for a collateral is lower by a configurable percentage than the current price. So this would be something similar to the way the debt ceiling instant access module works, where anyone can sort of make changes to the debt ceiling, but only subject to very specific protocols that are in the smart contract code. So this would be a similar thing for, if the price drop is greater than, say 50% or something like that, or wherever risk thinks, sort of the threshold for something that the liquidations 2.0 would deal okay with based on, the buff parameter and price curves. You can say anything greater than that, and we'll just go ahead and trip the circuit breaker. And that way, you sort of limit the downside loss. It's a very simple module. It can be deployed safely within a couple of weeks. We'll give more details later on exactly how that is and how that works and what the code looks like. Then in the longer term, we believe more robust mitigations should be implemented within the system itself. However, researching, testing, implementing them, getting them audited will take significant time, on the order of a few months from research to rollout. We have a number of pretty promising mitigations, but they need more rigorous study. And so we chose this plan because it allows the phased rollout of liquidations 2.0 to proceed, as is already committed to, with the addition of this permissionless circuit breaker in the short term. So there shouldn't be any further delay from this pending completion of final checks. We do need to keep integration partners clearly informed in advance about the planned upgrade that will install the more permanent mitigations and give them guidance on how to repair as early as possible. So yeah, in summary, we recommend continuing the phased rollout of Liquidation 2.0, but keeping this risk, this more severe risk in mind. We should add this permissionless circuit breaker, and we should, make a commitment to a future upgrade that will further mitigate Oracle price fault risk. And that's everything I wanted to say. So yeah, questions, comments, discussion.
So I guess this would mainly be on kind of risk to kind of just suggest a sensible setting for that parameter based on volatility, I guess.
Right.
Yeah, I guess we would look at worst case drops historically for each asset in 1 hour. So just intuitively, I know the most severe E drops, 1 hourly drops were about 27%. I'm looking just now at Link, we saw about 30% drops. So obviously we would go a bit lower than that. So yeah, I guess something between 40 and 50, but yeah, there's just something the number I came out with today. One other question I had, Kurt, you said that you would call this permission circuit breaker. You would probably call it for each collateral. You would need to call it for each collateral.
Right, because each collateral has a separate price feed. It could if we could configure it potentially, it would add some extra complexity to where if you have like three ETH variants that are all relying on the same price feed, you could make some kind of meta circuit breaker that circuit breaks all three of those collaterals that rely on the same underlying feed at the same time. So that would certainly be an optimization we could add, but the simplest version is per collateral.
Yeah, makes sense.
So I guess I have kind of questions about what we would do. So assuming that, so A, this is permissionless, right? So if the price drops by that amount, then anyone can come in and say freeze liquidations, right? Presumably then we need to turn them on again at some point, right?
Yeah. So
yeah,
we're still finalizing the design, but we have an idea for how you could also make the reactivation in most cases permissionless as well, right? So how that would work is when the circuit breaker gets tripped, you'd save whatever the last known good price was. And then if at some point in the future, the current Oracle price has a relationship to that last known price that's, less than the, sort of maximum allowed price drop, or if it's gone higher, then you could also allow it to be permissionlessly restarted. So you wouldn't necessarily need to have a governance action to restart in every case. I don't know if you can make every case a permissionless restart, but that would be the tentative idea there for restarting.
Yeah, also I'll highlight, this means that there does need to be a keeper that's checking when those price updates happen, because it's effectively going to do that sort of peep and peak and compare those prices. So every hour there needs to be a keeper that at least reads those values, and if they look out of bounds or it looks like the transaction would succeed, then it would send this this transaction there. If you didn't have that keeper, then you just wouldn't catch the price delta that would trigger the circuit breaker, and we'd be in trouble. So
can you freeze it with the upcoming medianizer price, or does it use the OSM price? And I'm wondering because there potentially you could be front run if it needs to check the OSM price, and then if something can go to auction and somebody gets that in before the circuit breaker, I could see that as problematic.
Well, what it's doing is it's looking at the OSM, and the OSM has two prices. There's the current price, and then there's the next price that an hour from now, or however long is left in that time span, will become the new price. So the circuit breaker is meant to be used when the current price is still some reasonable value, and it's the next price that's going to be a large drop. So it's circuit breaks before the bad price can be taken into the system.
Okay, cool.
So just thinking about this briefly. Does it make sense to have the like I'm kind of wondering how this kind of interacts with like the buff value, like so the multiplier that's added to the starting price. Like, would you always want those to sort of equal the same thing so that like if it does that make sense? Maybe that's I guess it doesn't matter. I'm just wondering if you could do something weird, like rather than freezing them, you just kind of like change the buff at the last second, right? And then start them at the old price or something in some weird way. But I guess if the price is 0, then your buff is infinite, so maybe that doesn't work.
I mean, yeah, I guess you could, but that has its own like edge cases and risks.
Yeah, for sure.
If a price of one way is coming in, you're like, oh gosh, we need to set the buff to 10 to the 20th or something. Well, you've got to have a method for resetting it back to something reasonable, and you can argue at that point like, well, we know that's a crazy price anyway. But that's an interesting point that you could also try to dynamically modify risk parameters. That gets more complicated, and we might that might introduce more delay if we wanted to go with some more complicated solution. Like that would be my other comment.
Sure, that makes sense.
Yeah, I'll highlight the benefit to this solution is that we've already had a bunch of engineers thinking about this over the course of a year-ish, and then we took the final culmination of all of that and sent it off to 3 auditors who like proper audited it, and 1 like simulator, and we've gotten feedback from like integrators. So the existing code that's out there has been reviewed with a fine-tooth comb. And so most of the changes that we want to make that are like more robust fixes would invalidate some of that review work and audit work. And so this thing being on the side, it's an instant access module, the same way the DC instant access module works. It's just an instant access module that will trigger the circuit breaker for us automatically. It's the lightest touch sort of mitigation to this tail risk that we could think of without invalidating the audits at this point. So we will cycle back, and because like I said, the impact is so severe in the edge case that and there are mitigations that we can put in place that we might as well do it. But yeah, so that's why we're recommending this solution.
Yeah, I think it makes sense to me. I think the point I guess I was trying to get to with buff was actually more about like how you would set the buff in relation to this price, right? So if you have like the freeze at like minus 40%, then do you set the buff at like it's not like 40%, but like the kind of inverse amount, so that if you drop by like 39%, then the buff means you're like 100% of market price, if that makes sense, right? So the biggest drop is matched. The biggest drop before the freeze is matched by the buff value. Does that make sense? Like the biggest drop that you allow, I guess, is then means that you would start the auction at the previous price, I guess.
Oh yeah. Yeah, and then what happens in the next time quantum?
I mean, then if it drops above the delta, then you just then you do the freeze, right? But I'm just thinking like at the point, I'm kind of thinking of the situation where someone knows what the freeze is and then manipulates it to go like right up to the freeze, but not actually at the freeze. You kind of want that situation to still end well for everyone, right? I think we lost Chris.
Oh, did you lose me?
Yeah, just let us know. That sentence.
Yeah, so you're highlighting the risk of this module is that an attacker or market manipulator or whatever might be able to get the price right up to the edge. Luckily, that's unlikely to happen in a malfunction, though. So
yeah, in an attack, in a malfunction, true. In an attack, you could set it to exactly that value, or you could potentially try and market manipulate it to exactly that value. But yeah. So yeah, if anyone has any other questions, feel free to chime in. But maybe because this has been a bit like doom and gloom, maybe we can kind of talk about some of the things that have to go wrong in order for the oracles to be like attacked or manipulated, or like you know, because you kind of several people have made the point that it's quite unlikely and quite difficult to do. So maybe we could
Yeah,
go through that
and
briefly.
maybe Nick or Marc-Andre would want to step in, but I mean, I like to think of it as there being like primary, secondary, tertiary systems, like control systems on a plane that are like keeping it afloat and, you know, or flying. And we really, with this edge case, are thinking, okay, all of those systems have failed. And we still think, rather than nosediving the plane into the ground, that we should toss a parachute at the back, right? So I mean, I think that's what we're aiming for here. I don't know if anyone on the Oracle's team wants to sort of talk about the mitigations that are already in place, you know, so that the Oracle prices aren't manipulated in this particular regard. It's, yeah. Not to put you guys on the spot.
I mean, yeah, Mark. I mean, if you want to take it, I know you know the Oracle stack forwards and backwards.
Yeah, well, I was just going to reiterate some of the basic predictions that we have in place. Well, first we have 26 different fees are pushing prices, right? So for an effective Oracle attack to happen, they basically have to collude among themselves. So that's not impossible, especially if the stakes are high. But the odds that would happen without us detecting it are relatively small. Of course, the pricing information is coming from more or less the same places, different off-chain or centralized exchanges. So if the pricing information gets corrupted in several exchanges, that could be a problem as well. So these are risks that exist, and there's very little way to completely protect against that. So I think the biggest layer of protection that we have today is the Oracle security module, the 60 minutes delay that gives us a chance to react if something bad happens, because we know that zero risk doesn't exist. But yeah, like you said, Chris, it's several layers of protection. It's good to think about this type of scenarios and making sure that we're protecting against that. And always we have to keep in mind that things that are safe today, we have to make sure that they remain safe if we multiply the total value of the protocol by 100 or 1000, right? So things that might not be very credible threats today could become one day a much larger threat. So it's perfectly fine to think about these cases.
Yeah, actually on that point, if I could add, what's interesting about this is if you can produce an Oracle.
Oh, sorry, Chris.
Oh, Starlink.
You have probably discover a good market price. You don't really gain anything from that Oracle attack, right?
Sorry, Chris, it was
very
interesting, but we missed all of it.
So all of it. Yeah, so under Liquidations 1.2, if you are able to collude and create one of these Oracle attacks, there's like no benefit to the attacker, right? So Liquidations 1.2's got a box, and you're in theory discovering a market price. You're not actually going to monetarily benefit, at least on Maker, from manipulating the Oracle price. However, under 2.0, if you can think of this like failure scenario as if you're positioned correctly to like grab all the collateral when this happens, all of a sudden, you know, this makes it much more advantageous to try and like pull an Oracle attack off. So we want to steer away from any attack vectors that scale with total value locked, right? And so by putting in a more robust mitigation here, we can prevent that risk from scaling as Maker becomes more successful and we have more total value locked. So that's it. I just wanted to re-highlight that point.
Yeah. So I sometimes think about it from like the other side, right? Like if you want to collude and attack the oracles, then so like your first like barrier is getting like whatever the quorum is, like 14 of 26 feeds to screw Maker over, right? Without telling anyone. Because if one feed defects and tells like Nick or Mark, then like we know, right? And then the gig's kind of up. And then even if that all goes well, you know, you have to there's a chance that governance will react fast enough to disable the OSM. And then, you want this kind of last protection as well, which is like, even if, governance doesn't react fast enough on the OSM, you then have this last blocker that stops any drop beyond a certain amount anyway, which kind of limits your total upside. So yeah, I think I'm not too terribly worried. It's, I guess, my point.
Yeah, one of the
sorry, guys, yeah.
right. So there's like layers of defense here, right? So with the oracles, there's not any one thing, right, that you point to. It's just kind of like, oh well, this, then this, then this, then that. So one of the things I've been thinking about lately is, so what if you do actually have like an oracle attack from the from the feeds, right? And they manage to queue up a price in the OSM, right? At that point, you have kind of 1 hour to freeze the Oracle security module before that price takes effect in the Maker protocol. Right now, we're kind of relying on the fact that you can pull off a governance vote in that 1 hour period to freeze the OSM. And what it is not guaranteed that in that 1 hour you can rally enough of the MKR, right, to have that governance vote. So I've been thinking whether there can be like some kind of permission, like multi-sig or something, that maybe the signers are like the mandated actors. Maybe there's like five of them on it, and you need like 3 out of 5. And the only power that the multi-sig would have is that they're allowed to effectively freeze the oracle, right? I think that might be a good kind of extra layer of protection. I'm not sure. I haven't really discussed it that much with the other mandated actors, so I'm not sure if they really want that kind of responsibility or liability. But I've been thinking about this a little bit.
Yep, I think maybe that's a discussion we should try and have another day. We're running a little short on time. Do you want to do a kind of more general Oracle update, Nick? We kind of missed you earlier.
Oh yeah, sure.
Because there's been some good news recently.
Okay, yeah. So for those of you who saw the forum post, this may not be that new, but effectively we had gotten the results back from Wbtca for the LP Oracle. They did have some feedback on things they wanted us to change. However, there was no kind of critical or high priority items that would show that the Oracle price could be manipulated, or that it was dangerous to use our Oracle in the current kind of configuration that we have. So while we do plan to make those changes, and we do plan to redeploy the oracles, I think the blocker in terms of the security of the LP oracle, I think that blocker has kind of been relieved. So we can look to increase the debt ceilings of some of the LP tokens. So I put a signal request together after we, when I say we, after the mandated actors discussed it on the weekly call. And our recommendation was that we adjust the USDC ETH, DAI ETH, and USDC DAI vault types. So we were, I think we made the recommendation of 50 mil for USDC ETH, 30 mil for DAI ETH, and 50 mil for DAI USDC. And it looks like so far, at least so far from the polling, it looks like the community agrees with that assessment.
Yeah, it's been encouraging to see the response there, I think. Yeah, we'll kind of end that like a poll on Friday, I think, and push it up next week. So hopefully as soon as, I guess, next Friday, we can see it in the executive. All right, so we're running a little low on time, but I think there was one more thing we wanted to kind of briefly cover. I think I think Amy or Operational Support were planning to kind of start, or kind of summarize, I guess, some of the discussion that happened in the meeting yesterday regarding MKR vesting and other incentives for core units.
Yeah, you're gonna hate me because it's not super quick, but I will try to get through it quick. So
so maybe we just kind of do a summary for the time being, and then we can sort of come back to it in the next
yeah,
call.
do you want to go back to next week?
Well, it's up to you. If the sort of summary of the call is quick, and then we can move the discussion next week.
Yeah, I plan to also move it to the forum post, but I wanted to give an overarching kind of where we're at. So this is just kind of talking about the different perspectives that were given. And just this will all be in a post a little bit later, but just things around the framework design as well. And some of the stakeholders that are involved in this idea around these vesting incentives and so on. I do want to keep this up, which is this idea that there's a lot of the discussion and a lot of them are nuanced. So the way that the framework is done, the budget includes the incentives, the salary, and like operational costs. So that makes sometimes conversations a little bit difficult to do within one thread. So that's also why we want to pull some of that out. But there are kind of different points to it, which I read a lot, which is around salary itself, the amount of salary, the incentives or the amount of the incentives and vesting, and then the structure of the incentives like vesting, the sourcing of MKR, if it's MKR and its mechanics, some social contracts around MKR and minting, and then whether this should be a consistent approach across core units or proposed per core unit. I won't go through Derek's proposal because he went through it in the call, which is in the YouTube video. But I did want to pull in some of the things he covered, which is around the why of the compensation package that they're proposing. And then we did discuss in the call a little bit around different parameters that we could still kind of talk through, which is cliff or streaming. There's some conversations about what that vesting might look like and so on. This is the crazy one that really has everybody's thoughts and different perspectives. There's kind of this discussion, like underlying discussion around the social contract of minting and MKR. And there's some discussions around like the power to mint, the reason for minting being kind of conflicting to some of the ideologies that are under discussion. And then with minting itself, so there was some proposal of like how we could think about minting and what that amount could be. And then a little bit about the burner too, if we are able to, if it was instead of MKR being burned and we got that instead of minting, what those things are. There was an interesting conversation in the call yesterday around buybacks as kind of like a vector attack by front runners. And a little bit more around like why MKR should be kind of set aside, or that this minting might be a more effective mechanism. Everyone has different ideas on it and thoughts. Juan has a nice diagram that he kind of explains why. I won't go through it in detail right now. And then I also want to propose some other ways to think about incentives, not just vesting or MKR in general, but there was discussion around options. So the purchase, being able to purchase, how we can think about performance-based bonuses and so on. And it could be either on just rewarding specific to core unit amounts to core units instead of each core unit proposing something. And then how that could kind of tie into some of the work we've done with SourceCred, maybe how thoughtful it took to think about how much each member who's participating and giving back to the group effort is receiving it. Some other questions came up as well, which is a big one, going back to, should we kind of scale and standardize this for other teams? Part of it could be to reduce any kind of competition that might come about. Can there be a framework, because there are kind of global and approaches that and specific approaches that different core units want to have? And then there's sort of aspects around what happens if a contributor jumps between core units, like what does that package look like for vesting? What are the plans for the foundation MKR, and could this be used for that? And how, if we're thinking about performance, then what does that look like, and how feasible would that be? So that was just like the super brief overview. I can go back. I mostly planned for this to be a discussion amongst everyone here. So if anyone wants me to go back to any of the pages to go further, I don't know how long if we have time for discussion, or if we're going to save it for next week.
Yeah, we may be running a little long. We were just discussing in the sidebar about potentially having like a specific meeting for this kind of topic. So maybe sometime next week or the week after. I think that probably fits a little bit better than trying to cram it into sort of 10 minutes now. So I think that was kind of a useful summary, and I hope people are going to consider it as a kind of introduction to potentially a meeting where we can discuss it in more depth. So yeah, I think we'll try and sort of schedule a meeting like that coming up soon. So yeah, kind of look out for that on the forum. We'll try and make sure it's clear and visible to everyone. All right. So there we go. Despite having a lot of stuff, we will be ending slightly early, which is good. So maybe are there any last minute kind of comments or questions or thoughts people want to share before we wrap up for the week?
Going to the moon?
Cool. All right. It sounds like nothing major. So yeah, yeah, we'll schedule this. Well, we'll have this meeting again next week as usual. Final reminder to again check time zones and check daylight savings times. But yeah, I will talk to you all soon. Thank you everyone for coming.
Thank you, Long.
Thanks, everyone.
Bye.